Okay, a few weeks ago, I wanted to lunch with a friend. He's someone I've known for a while. He lives out in Newport Beach. He's been investing in apartments for over 30 years and honestly done really well for himself and his family. He's the kind of guy who's quietly built wealth, real wealth, through multiple different cycles. So he's seen the highs, he's seen the lows, and he just kept investing through it all. Now, over lunch, he told me something that honestly, I haven't been able to stop thinking about. He said, everyone's waiting for the perfect signal or the perfect time, but the signal might have already happened. Most people just didn't notice because they were too busy reading headlines. And that stuck with me because right now, apartment investing, it's in this weird place. Where the data is actually getting better, but the mood hasn't caught up yet. Now, if you understand how cycles work, you know that gap between how people feel and what the numbers say is usually where the best opportunities live. So I'm going to cover what happened in 2022 that shook the whole entire market. I'm going to get honest about what that's meant for my own portfolio. And then I want to talk about where things stand right now. And more importantly, what it actually means for a physician who's thinking about their next move or their next investment. And if that's interesting to you, stay tuned. Welcome to the Passive Income MD podcast, where we talk about creating your ideal life through multiple streams of income. If you enjoy hearing about this stuff, make sure to hit subscribe. Now let's get on with the show. All right, so let's start with what happened. If you don't understand 2022, nothing about today's market makes sense. Now, coming out of the pandemic, if you remember, interest rates were basically at zero. Money was real cheap. Mortgage rates were in the threes. Now, who out there got their mortgage or refied their mortgage into the threes? Congratulations, or even sub threes, even better for you. Now, if you wanted to borrow money to buy an apartment building, even at that time, the terms were so favorable. A lot of investors did exactly that. They just jumped in. They used short-term loans with variable interest rates, and they planned to sell or refinance just within a few years when things looked even better. And then the Fed started raising rates. They did it way too slow at first, meaning that the reaction was too slow, and then they did it fast. Now, starting in March 2022, the Federal Reserve, they raised rates by 5 full percentage points over about 16 to 17 months. And that was one of the most aggressive rate hike cycles in over 40 years. So in our lifetimes, in our investing lifetimes, it was the fastest, most aggressive rate hike that anyone here has seen. And in 2022 alone, they raised rates 7 times. Mortgage rates went from about 3.4 in January to over 7% by October. Now, most people in the industry expected rates to go up eventually. That wasn't the surprise. The surprise was the speed at which it happened. Now, I've talked to experienced operators, people who have been doing this for decades with billion-dollar portfolios, and they'll tell you the same thing. Nothing in their careers prepared them for how fast it moved. The effects were immediate. Those short-term loans, they got expensive real fast. Monthly payments jumped. Refinancing became harder or impossible. Now, on top of that, many loans required something called an interest rate cap, which is basically insurance against rising rates. There are these big hits that come every so often, whether it's 6 months or a year. They have to pay for that insurance against rising rates. That might have been a couple $100,000, some in the 7 figures. Now, those caps used to cost almost nothing. Suddenly, again, they were in the hundreds of thousands of dollars, sometimes over $1 million. Now, all of this was happening while rents were flattening. Most of the times we were used to rents going up a little bit, just over time, they were flat. And costs like insurance were skyrocketing, sometimes double, triple, quadruple. And here's why I'm telling you this. If you invested in a passive real estate deal around 2020 or 2021, and the returns for you haven't looked anything like the projections, this is a big part of the reason why. It wasn't necessarily a bad deal or a bad operator. It was a shock to the entire market. I want to be real with you about something. I'm not talking about this, just from the outside. I've been investing in real estate for over a decade and closer to 20 years if you count our very first condo that we rented out. In that time, I've had deals that have done really well. I think I've shared it with our community quite a bit. Returns that, again, changed our trajectory, our family's trajectory, and what we thought was possible. Of course, there are deals that I'm so grateful for that I had the courage to get into, especially when I didn't know much. But honestly, I've also had deals that haven't performed very well. Deals where the returns came in well below projections, where I lost some money, and some that I'm still waiting and watching to see how they play out. So if you've been in that situation and you're sitting there looking at your quarterly reports that honestly don't look anything like what you were shown when you invested, I want to let you know I understand. I've been there too, and I'm in it with you. I know how tempting it is at that moment to say, like, I'm done. Real estate, it doesn't work, especially if that's when you started. I've heard that from friends. I've heard it from members of our community. But here's how I think about it. There's this concept called vintage risk. It means the year you enter a deal matters. Now, I think it originates from the world of wine, where the year of the grape harvest, depending on what year it is, can change the quality and taste of the wine significantly from year to year. You know this, a certain year, a 2012, might be significantly different from a 2011. It all depends on the weather conditions, the environment, all of that. So if you invested in 2021 with that cheap variable debt and you had those assumptions at that time, they eventually turned out to be quite aggressive. Now, your vintage was really tough at that time. I mean, again, that doesn't mean you made a bad decision. You made it the best decision you could with the information available at the time. It just means the environment shifted around you in a way that nobody predicted. The flip side is also true. Now, if you're looking at a deal today with, let's say, better pricing, fixed rate debt, lower debt, and a motivated seller, I mean, again, that's a completely different vintage. But you can never know in advance which vintage will be the best one. I mean, there are people who've been calling the top forever. They called the top in 2021, and maybe they were right, but they also called it in 2014 or 2016 or 2018. Eventually, they were right, but they probably missed years of solid returns while they waited. That's why I invest consistently, not recklessly. I still do my homework. I still vet deals carefully, but I stay in the game through every part of the cycle. Because over 10, 15, 20 years, you probably heard this before, time in the market beats timing the market. Now, the ups and downs, eventually they average out, and hopefully they continue to trend upwards over time. And what you're left with is a portfolio built on discipline, not luck. Not every deal has been a winner, and I'm still investing. Those two things, they're not contradictory. I mean, that's the whole point. With that context, let me actually walk you through where things stand right now. And I'll try to translate each piece into what it means for you as the physician investor. Let's start with interest rates. The federal funds rate is sitting at 3.5 to 3.75% right now as a range. The Fed cut rates 3 times in late 2025. And that brought us down from the peak of 5.25 to 5.5%. But they've been holding steady since January. Inflation is at about 2.4% year over year. Again, that's still a little bit above the Fed's 2% target, but it's definitely way different and worlds apart from the nearly 8 or 9% we were dealing with in 2022. Now, I have no idea what's going to happen, especially as a result of some of the geopolitical stuff we're dealing with today. But what I do know right now, again, for apartment investors, specifically mortgage rates on multifamily properties, they start around 5.1% for the best loan products with average rates closer to 6.2%. Now, here's what matters if you're a physician evaluating deals right now. I want to let you know rates are not going back to 3%. Not anytime soon, maybe never. I mean, that era is over, but that's actually a good thing for you. The low rate environment is what caused this whole frenzy, the over leveraged deals, the aggressive projections that blew up. A higher rate environment filters a lot of that out. It forces better underwriting, more conservative assumptions, and more discipline, which means that the deals you're seeing today, if they pencil out at these rates, they're most likely built on a more honest foundation, more realistic numbers. Now, let's talk about property values. I think this is where a lot of physicians get confused. So let me break it down. In commercial real estate, properties are valued based on the income they produce. There's a metric, it's called cap rate. That's short for capitalization rate. And let me just explain to you, the idea is actually simple. It's the property's annual net income divided by the purchase price. That equals cap rate. Think of it kind of like a yield. If a property makes $100,000 a year and you paid $2 million, that's a 5% cap rate. Now, if you pay $1.5 million instead of $2 million for that same property, now your cap rate is closer to 6.7%. It's just a math equation. Now, higher cap rates, just so you know, means you're paying less for each dollar of income. It just means usually higher cap rates mean a lower purchase price, okay? That's usually a better deal for the buyer. Hey, what's up, everyone? Just want to ask you a quick question. Are you ready to take your medical career beyond the traditional boundaries of medicine and amplify your impact? Well, I want to tell you about the Leverage and Growth Accelerator community. Just so you know, we created this exclusive community just for physicians like you who want to expand their identities,
without giving up their doctor identities. It's an add-on, it's not a replacement. When we hosted our first Leverage and Growth Summit, I know many of you have been part of that, we realized that so many doctors were inspired by the what and why of entrepreneurship, but needed help with the how and when. And that's why we created this community called the Leverage and Growth Accelerator to help doctors learn how to start, grow, or scale a thriving business and connect with like-minded individuals who also want to make a positive contribution to the world. Within this community, you're going to experience a life of greater fulfillment. It's really a powerful antidote to burnout where you can leverage your medical degree for new opportunities and take command of your time and schedule so you can invest in your family's future while enjoying today. In the Leverage and Growth Accelerator, you're going to have access to educational materials, you're going to have insights from expert speakers, small group coaching, and most importantly, you're going to have community support to help you realize your untapped potential. And we're so confident in the transformative power of this members-only community that we're offering the first 30 days for free. If you're interested, I want you to take advantage of this window of opportunity. It's not going to last forever. So go now to lgacommunity.com. Again, that's lgacommunity.com. If you're ready to take your medical career to the next level and make a profound impact in the world and do it together with other like-minded people, it's time to join us. We can't wait to see you inside.
Back in 2021, just want to let you know with everything happening with interest rates and inflation, cap rates hit historic lows, around 3.8% nationally. Just remember that number. Investors were paying huge premiums, banking on rents going up and rates staying low. So when the cap rate was low, purchase price was high. So since the rate hikes, cap rates, just so you know, they've climbed up to about 5.7%, and they've stayed there for about 7 straight quarters. And again, that's the longest plateau in 25 years. And so what does this mean for you? I think this means the market has already repriced itself. Again, we're not waiting for a correction. It already happened. Like if you were nervous about buying at the top, that concern, I think, is mostly largely behind us. The question now is whether prices stay here or they start ticking back up. And most industry surveys, talking to the experts or people that are close to the data, they suggest that investors expect these prices to stay flat or gradually improve from here. Here's a practical takeaway. When you're looking at a deal today and the operator's projecting, let's say, that cap rate of 5.5% going in return, and that's based on current income, again, that's a fundamentally different proposition than someone projecting a 3.5% return in 2021 and hoping that appreciation is going to make up the difference. Today's deals, if they're underwritten conservatively, they start from a, again, much more honest place and a place with some buffer. Let's talk about what's happening on the ground. Because the mood in the market is pretty negative right now. I actually think that's something worth paying attention to. The apartment transaction market, all that volume, it's been slow for about 3 years. Every year people say this is a turnaround year, and every year it's been slower than expected. I think part of the reason is that there's a huge wave of debt coming due. Apartment loans maturing in 2026 alone are expected to hit around $162 billion, which is a 56% jump from last year. Now, a lot of that debt was originated back in 2021 and 2022 when terms were easy. Now those borrowers need to refinance at higher rates, which often means they need to bring more cash to the table. Now, some will manage it and some won't. And when they can't, those properties either end up in foreclosure or they end up on the market at discounted prices. And banks, over the last couple of years, they were working with borrowers, but they're starting to stop extending those troubled loans and instead pushing those assets to market, getting it out there so it can be sold. Now, here's why this matters for you, and it's important for you to listen very carefully. This creates a window. For the last few years, everyone's been talking about distressed deals. They've been so hard to find, but that is starting to change. I think this year is where it really starts to change. Some investment funds are already targeting properties bought in 2022 with short-term debt that are now underwater, picking them up well below replacement costs. Now, you don't have to be a fund manager to benefit from this, but if you're investing passively, this is the environment where the quality of the operator, it matters more than ever. The right operator in this market, they'll be able to find and acquire these properties at a discount with better debt terms and position it for the recovery. The wrong operator is the one selling you the deal that's in trouble. Unfortunately, that means there's an operator on the other side. They're the ones selling you the deal that's in trouble, and knowing the difference is everything. One more piece of context. After years of just heavy apartment construction, again, people took out loans early on, they developed these properties. That new supply, it takes about 3-4 years to come on board. That pipeline is shrinking pretty fast. In some of the markets that saw some of the biggest building booms like Austin, like Denver, like Phoenix, new deliveries are expected to drop 40 to 50% this year. And at the same time, demand for apartments is holding up. Homeownership, as you probably know, it's still out of reach for a lot of people. Those costs have not come down. The monthly cost premium to buy a home versus renting is over 100% in many markets. So just people, they keep renting because that's what makes sense. So when supply drops and demand stays strong, that's when the fundamentals start shifting back in favor of property owners. Now, we're not fully there yet, especially not in every market, but the direction is clear and it's heading in the right way for investors that are getting in the game right now. Let me bring all this together. And I want to do this in a way that's actually useful. Again, if you're a physician investor sitting on some capital, or you're thinking about whether now is the time to invest or wait, here's how I think about it. First, understand what kind of market you're in. This isn't a market where every deal is great right now. Every deal works. Everyone looks like a genius. That time will come, but this is a market that rewards being selective. Now, someone show you a deal that only makes sense if rent grows a crazy amount every year and rates drop another couple points. Well, that investment is probably based on hope. I think at this period of time, this is a deal to walk away from. The deals worth looking at today are really the ones that work based on income. The property generates a decent amount of income right now and it works, and not on best case projections. Second, pay attention to the debt. I've had to learn this the hard way personally. Now, ask what kind of loan is on the property or what kind of loan the operator plans to use. What's their exit plan for that? Is it a fixed rate or variable? What's the term? When does it mature? Again, a lot of the pain in this cycle, and I've experienced this, came from variable rate, short-term debt. If an operator is putting fixed rate debt on a property at today's rates, that does give you some stability and predictability. And so you're going to know what the payments are going to look like for the life of the loan. And I think that matters right now. Third, of course, the most important thing, look at who's operating the deal. I don't mean just their marketing materials. Of course, you want to look at their track record. You want to see how they're performing before this cycle, in this cycle. Did they communicate honestly when things got tough? Did they do everything they could to protect investor capital? Did they survive? I think that's a big one because so many operators did not survive and they're not going to survive over the next couple of years. The operators who actually made it through the last couple of years without blowing up completely are the ones you know are going to be around and the ones you want to be investing with going forward. Now, this cycle is a stress test and it's separated, I'd say, the serious operators from the ones who just got lucky in a good market. Now, fourth, think about your own timeline. If you're investing passively in real estate, again, this should be a long-term play. 5 years minimum, usually longer. The short-term noise, the headlines, the speculation with rates, again, none of that matters if you're underwritten correctly, like you do it the right way, the due diligence, and you're in with the right people. That's what matters. What matters is, again, the price you buy at, the way the debt is structured, and the fundamentals of the property in the market. I'm not going to sit here and tell you this is the perfect time to invest. Nobody knows exactly when that is. But again, it's around this time when people say this is the point of maximum opportunity, because this is the time when wealth transfers hands more than ever before in tough times. Now, you've heard me say it before. Again, I don't believe in the ability to time the market perfectly. No one can do that. But what I will tell you is this: the conditions that made the last few years so painful, the shock with rates, the over-leveraged deals, the aggressive assumptions, a lot of that stuff has largely cleared. Property values, they've reset. Debt is more expensive, but more stable at the same time. And again, the people who are speculative buyers, they've stepped back or exited the market completely. And for the patient, educated investors like people in our community or in our courses, the setup is better than it's been in years. Now, if you've been on the sidelines, I totally get it. But the window where you can be selective, buy at better prices, and partner with proven operators, that window, I'll tell you, doesn't stay open forever. It closes when that sentiment, we talk about it, catches up to the data. That gap closes and everyone starts competing again. So if you've been listening to this and thinking, okay, I get the big picture, but I still don't really know how to evaluate a deal or vet an operator, just want to let you know, we do cover that within our Passive Real Estate Academy. We have a cohort that's going on right now. If not, there's a wait list for you. We can let you know when the next cohort happens. It's an incredible opportunity to learn, build skills together and do it the right way. And of course, you end up with a community of people who are sharing info, sharing about deals together. This is a team sport. So let's figure out how to do it right and do it together. We walk through how to analyze deals, how to read numbers, how to ask the right questions, how to understand where we are in the cycle, and what that means for specific types of investments you should be considering. Again, it's built for physicians by physicians. And honestly, in a market like this, that kind of education matters more than ever. This is when you start seeing some of the best deals when they're available, but only if you know how to spot them, how to evaluate them, how to find the right people to make that happen. If you'd like to join the wait list or find out more, just go to passiverealestateacademy.com. It'll be there, or you can find the link again in the show notes. As always, thanks for taking the time to learn and invest in yourself. Keep building, keep working hard, and I'll see you next time. Thanks, everyone. Enjoy the show? Let me know by dropping a review in the podcast app you're listening to us in. And if you haven't already, make sure to hit subscribe. Join thousands of physicians who are also on this journey to creating their ideal lives through multiple streams of income. Learn more at our website, passiveincomemd.com. Thanks again for allowing me to be a part of your journey. See you next time.